Hello, everyone. A warm welcome to the fourth session of our Sustainability Dialogues on understanding the sustainable investing and ESG practices among financial industry players. This session is sponsored by Prudential. My name is Prachi Seth, and I head the Climate Action Platform at AVPN, and I will be your MC for this evening. For those of you who do not know about AVPN, we are a network of funders and resource providers with over 600 members across 32 markets. Our mandate is to move more capital towards impact in Asia by providing social investors like yourself opportunities to connect, learn, and lead. We are really excited to organize these sustainability dialogues and galvanize conversations around ESG and sustainability in Asia. I would now like to introduce our panelists for this evening. Unfortunately, Lynn wasn't able to join in for this discussion, but we are replacing her with a very dynamic David Chua, who's the Chief of Staff at Prudential Singapore. We also have Evelyn Chan, our Vice President, WWF Singapore, Joanne Q, Director, Sustainable Finance, Standard Chartered, and our moderator, Shireen Fo, who's the Practice Lead, Sustainability Services, KPMG. Shireen, over to you.
Thank you, Prachi, and welcome everybody to the seminar today. So very pleased to meet you. So for now, I will be your host for the session and definitely very excited. So I'm Shireen from KPMG, and I think all of us here would have signed on in a lot of the excitement, seeing where the financing industry is as of now with regards to ESG. And for KPMG ourselves as well, we have seen that investing responsibly is a huge area, not just for your current situation, but also with a huge potential for growth. So over at our end, I think it has been sufficient potential for us to also establish our center of excellence for private equity, for example, or even then discover a lot of new tools that will, I think, interestingly map your financial services sector to your real sectors where the greatest impact are actually going to be felt and developed. And so today, very happy to have everyone with us. And if you look at the panel, you would have David from Prudential, and obviously Prudential is a very key player in this entire dialogue. And also our sponsor for today, we have SCB, Joanne, and SCB, as you know, is also heavily involved in Climate X, for example, in the launch, and Evelyn. So Evelyn is actually from WWF, and she will then discuss with us that link that we talk about, how do we build the bridge between the financial services sector and the real industry. And that is the part, I think, where we have to be cognizant, in my personal view, right, to understand that the models that we are used to in terms of business and commerce are going to be changing. So we can't have an isolated financial institution with no understanding of the real sector, or the other way around. And this entire sustainability conversation is really helping us converge that. All right, so thanks a lot, everybody, for joining us. And we will have our first speaker for today. May I invite David, as the only gentleman here, to kick it off. And David, Prudential has always, of course, been a significant capital allocator in the industry, right? And what we are really keen to hear from you as an introduction for today is that we know that you have adopted a principles-based approach, right, to coordinate responsible investing activities, and that is going to cut across all your different lines of business and include your corporate strategies and goals. So could you share a little bit of this with us, a little bit more of how Prudential is looking at sustainability and how you do the alignment?
Yeah, very gladly, Shireen. Hi, good afternoon, everyone, and thanks for joining us. So I think, Shireen, for maybe just as an introduction to Prudential's ESG strategy, right? We have, I think, taken a more holistic view, and as you said, a more principle-based approach towards tackling this ESG strategy. There are, I think, essentially three key areas that we look at. One, I think for us as a life insurance company, to be able to make health and financial security accessible to everyone, right? And the second is by doing so, to be able to build social capital. And third, which is relevant for today, will be how we can steward the human impact towards climate change. So the responsible investment, right? It's clearly a topic that's very close to me, even during my days of overseeing the investments for Prudential Singapore in my previous role. It is one of our strategic enabler because through this, we will be able to support the transition towards a low carbon economy, right? Through one, being able to decarbonize our investment portfolio. And secondly, also to be able to ensure that it is an inclusive transition together with our fund managers and our investee companies during this period. So I think for us, we have developed a group responsible investment policy, which basically covers our approach. Just to give an example, right, we have taken the approach to include ESG factors as a material long-term financial impact in terms of how we analyze the portfolio. So this is what we call the ESG screening as an integrated approach to how we build our investment portfolio, targeting to cover 100% right, of our portfolio during this period of time. Now, I know there has been a lot of media release over the last couple of weeks around how ESG is being defined. So we are also, I think, at this stage where we are trying to better refine our framework between what is ESG screen versus ESG promoted or ESG targeted strategy. Here, I think I would just like to emphasize that our goal here is to be able to better define and control this way of defining so that as we communicate with our fund managers, we are able to then make sure that this gets translated into how they implement and execute the mandates that we give out. So I think maybe just to end off this question, we do recognize that as an asset owner, we do need very active engagement with our banks, with our fund partners. So this is something that we seek to make sure that we have a more amplified and a powerful voice. We do this by making sure that our fund managers are able to engage actively and they do influence companies in the areas of business sustainability, the way they behave. Our expectation is also for them to report back to us what is the progress that they have made with the investee companies. On the broader alliance perspective, Prudential as a group, we also actively collaborate with many of all the initiatives that the participants will be familiar with, the UNPRI. Just recently, we signed up for the Net Zero Asset Owner Alliance. So something that we are taking very seriously in achieving it. So I think just to end off, we recognize, just like everyone else, this ESG journey is an ongoing process, right? It is still very largely evolving. We are learning together with our partners, and definitely we will be looking forward to see how the regulatory environment, businesses, practices, as well as technology, how they can then help us to develop this ESG outcome a little bit better in the coming years ahead.
Thank you, David. Definitely a very progressive approach that Prudential has taken. And later on, I think during the conversation, we'll also be very keen to hear from you in practice. How does this actually translate for some learning lessons to the audience? Thank you. So I'm going to move on now to have Evelyn maybe give a quick introduction of yourself, Evelyn.
Thank you, Shireen, and hello everyone. I'm Evelyn from WWF Singapore. I'm part of the Sustainable Finance team. So within my team, we engage with multiple stakeholders within the entire finance industry, ranging from the banks to the regulators, asset managers, and asset owners. And we support them in the integration of sustainable practices within their business models and areas of work. So to facilitate this, we have developed very separate, distinct frameworks to cater for each industry group. Like for instance, for banks, we have the SASPA. For regulators, we have SOSREG. And for the asset managers, we have the Respond framework. So as mentioned, each framework will address the specificities of each sector and will also help to guide the industry players along in the ESG journey. The framework has also a dual purpose because it also allows us to assess these institutions and their level and in terms of their depth and breadth of their ESG integration into their business models.
Thanks a lot, Evelyn. I just have a question.
Sure.
Right. What is the shift that you have seen in recent times around the work of WWF and how you interact with the financial institutions? Has there been an increase in interest or, more questions and understanding around the sectors that WWF is helping to conserve, for example?
Yes, I'm very happy that brought up because it is very encouraging that we've actually been seeing really very good signs of increasing interest coming from the investment community, as well as asset managers and banks into how they can actually further this ESG journey. And what I see is actually genuine interest in the environment at large, maybe because of even the current unique times like COVID. So I think that's further heightened this awareness. So actually that we are seeing two trends. First of all, is that there's an increased interest in capacity building. And to support that, we are very excited to say that ASFI, which is an initiative under WWF, the Asian Sustainable Finance Initiative, we are going to launch IBF accredited e-learning courses. And this will also help for financial institutions in the capacity building. Perhaps I think we can share more when these courses are going to be actually officially launched. And also at the same time, we noticed, as what David has actually already mentioned, that there is now more need to categorize ESG products clearly so as to reflect the level of ESG impact for these products. So to just give an illustration, on one end, perhaps we have products that have exclusionary policies. Maybe they want to exclude brown industries, fossil fuels, or maybe bio-waste, for instance. And in the middle, we have what we call like ESG integration, whereby ESG factors are integrated into the investment model. And therein comes active engagement with the investing companies to deliver that kind of ESG impact from the investment activities. And on the other end of the scale, we have SDG-themed investments and impact investment funds. So these are what we call have the maximum ESG impact, because this is where capital is actually being focused and channeled towards businesses that are sustainable, technologies that will promote sustainable practices, or businesses that are in transition. So we are very excited for this trend because we do see the need for capital to be actually directed to where ESG impacts can matter the most.
Understand. And it'll be interesting also later on to hear, right, in terms of these different buckets, whether we are seeing a shift in the needle around the allocation between these three different buckets, right, whether we are moving more and more capital in there or what is stopping us from doing that. Okay, I'm going to first move on to Joanne then. Hello, Joanne.
Hello, hi everyone.
Hi, Joanne. Thanks so much for joining us today. So I wanted to just have a quick introduction of yourself and also the work that StanChart has been doing in the space, right? So of course, StanChart has been very aspirational, and we did notice that you also have certain very well articulated position statements, policies, and so on. But beyond all that, I think what really impressed me was you have actually a very clear two-pronged approach, and I'm sure this is not inconsistent with the rest of the market, but the articulation around it is very clear, I think, and that is a good signal around the way StanChart is actually looking at it internally and the clarity that you're providing for your own people as well as the market. So if you would like to share a little bit more about yourself and the work that you do there.
Sure, happy to do so, and happy to be on the panel. Thanks for inviting me along as well. So I come from the Sustainable Finance team in Standard Chartered, and I'm looking after both helping our clients to continue to access capital in a market that is increasingly becoming sustainable. So I think, as Evelyn and David mentioned earlier, we are seeing increasing interest and also sophistication in the market in terms of investors as well as lenders. That they're looking out specifically for corporates to lend to that are also sharing the same values. So what we do here in my team will be to help corporates to, for example, tap the green bond markets, the sustainability linked bonds and loan markets, so that they can continue getting capital and channeling it to the right places. We also help them to continue to do so not only by issuances like bonds and loans, but also to create platforms where they can access the sustainability market through new or newer revenue streams. And I think, Shireen, you brought up one of these at the start of the introduction itself. So Standard Chartered is involved in the Climate Impact Exchange for the buying and selling of high quality nature-based carbon credits alongside Temasek, DBS and SGX as well. So what we hope to do here is to inject quality and liquidity into carbon markets in order for there to be a new revenue stream. So for example, like if you're a developer now developing a nature-based project like a mangrove forest or forest somewhere in Asia, now there is a new access to capital, you're broaden up access to a wider range of investors, and this is something we are keen to enable. I think Shireen also mentioned that we have articulated some sustainability aspirations as well, and these represent measurable targets to support UN SDG outcomes across our businesses, our operations, and the communities that we impact. And one of these is the sustainable finance pillar as well, which is pretty key to continuing to help us achieve impact, but also continue to help our clients access the markets. I think you also mentioned there is a two-pronged approach that we take, which is do not harm and also to do more good. So in terms of this really goes to the heart of how we operate as a sustainable finance team and also as part of the whole Standard Chartered Bank. And I'm happy to speak more on this subsequently as well. But in a nutshell, this will speak towards mitigating risk or the do no harm component, where we have our environmental and social policy frameworks that are in line with industry best practices, such as the Equator Principles, of which we are the current chair as well, and aligned to standards like the IFC performance standards. We also have position statements that will guide our actions towards a high, I guess, sectors that are a little bit more sensitive, such as mining and metals, agro industries, and so on. And on the doing more good component, this is where we recognize that we can't just mitigate risk, but we also need to continue to increase our positive impacts. And we do publish an impact report on a yearly basis as well. And in our 2020 impact report, we have stated down targets as well that we are tracking. For example, how many people we are impacting through loans to microfinance institutions, and also assets that are aligned with our sustainable financing framework.
Thanks so much, Joanne. I think what is coming through very clearly for me, and also I hope for the audience, is that the people around this table are really representing organizations that are not just picking it up, but really trying to do good work around having a voice in shaping the industry, right? And that I think is in itself very important. And Joanne, I just wanted to kind of build on the point that you brought up earlier around, I think you mentioned quite a few times nature-based credits and different sectors. And I wanted to kind of bring it back to what F-Line shared with us earlier around the different sectors and the frameworks that WWF has. How would you advise like an audience who is starting to look at investing in nature-based credits? And David, please feel free to weigh in as well, of course.
Yeah, I think this is a very interesting question and very pertinent as well, because we do see the investment, for example, in nature-based credits is closely tied to how we think the carbon markets will start growing in the future. And this is a market that we see increasing promise. Right now, I think there are about 1,800 corporates who have established a net zero or carbon neutral target. And what happens is that driven on the back of these targets, corporates now are held to it. So like us ourselves, we do have a net zero target that we have to reach by 2050. So the first priority, of course, for all these corporates will then be to reduce emissions as much as possible. But right now, due to technology limitations and so on, we cannot reduce down to zero just by technology improvements alone. And we have to offset the remaining then through the purchase of carbon credits. But here is where it's important, where CIX, which is the Climate Impact X, come to play to ensure that you are buying the right credits that ensure proper removal of carbon dioxide from the atmosphere. And where we see the most like additionality is in the nature-based solutions at the moment. So it's very clear, for example, if you are supporting a like reforestation project or like that carbon is actually being removed from the atmosphere. So in terms of this, we do see the carbon market growing, buoyed on by the demands set out by these corporates. And to understand how to look at nature-based solutions and their promise in the future will be then tagged to this growth of the market. And with it comes the growth of carbon pricing as well. So right now we are seeing that nature-based solutions, for example, are the most traded, one of the most traded commodities on the voluntary carbon markets, and those that have demonstrated clear co-benefits. For example, this could be livelihood benefits in the project or biodiversity conservation benefits, do command a premium in terms of pricing. So as the markets develop, and we hope to add to such a reliable data through the operations of CIX in the near future, this will mean that nature-based solutions then will start becoming more attractive. And for example, we do see some of our clients already starting to get ready for this phenomenon by acquiring natural assets in anticipation of the assets actually not only becoming profitable, but in a sense also aligned to their sustainability goals of like trying to reduce their own greenhouse gas emissions as well.
Just to add on to what Joanne said, I really love the idea of the CIX. It is definitely very forward-looking. I mean, even though we sign up for the net zero, we are also very aware between now and 2050, achieving a target is going to be very dependent on a lot of factors that we cannot see today, right? The use of technology, like what Joanne has said, how the companies are going to evolve over time, right? In terms of their best practices to help us to get down to carbon neutrality. For us, I mean, Prudential as a group here in Asia, right? We have a footprint across most of Asia. Many of them are maybe even still markets that are still very reliant on some of the fossil fuel, for instance. And being a very localized business in the way we sell our insurance policies, we also tend to invest locally, right? So I think there has been some challenges that we also have seen whereby if we have to invest into a stock market whereby 30 to 40% of them are in fact coal companies, for example, or fossil fuel based, right? That almost compels us to have some kind of investments, which is where I see this technology and the engagement coming in to be very useful. CIX, I think, as discussed, will be an avenue that we should be looking at in the decades to come.
Yes, KPMG is also extremely excited about that. We have a lot of clients who are asking, you know, what is happening? When are we going to take the next step? In fact, sometimes we have to hold people back a little bit while we wait for the launch. There are a lot of excitement. I just wanted to also understand, in the panel here, right, what are your views around investing in some of these new nature-based solutions versus, for example, managing your own portfolio? I mean, in a nutshell, I think I'm asking the question of transition financing, right? Is that something that you think is going to be a huge challenge for the industry in the near term?
Yes, maybe I could say a few words around this as well. I think transition financing is a key theme for us and definitely for the rest of the industry, because as I think we all set our own net zero targets, it will mean that we need to look at our portfolio, a large portion of which will lie in Asia as well. And just saying that we want to exit high emitting clients is not the answer. I think that's why I think when it comes to maybe personal, also the way that we look at investments at a corporate level, transition will be key. And on this, we have several transition pathways already done for our industries. And I think this will be a very exciting space to look at in the future. So that's what's happening in terms of trends.
That's great. That's quite in line with what I'm seeing as well. And F-Line, I think just now Joanne mentioned the term additionality, right? So for the sake of the audience here, what would be your view around which sectors are going to be most contributory to this actually in a real world sense?
Okay, so you mean in terms of the areas of investment where these sectors are going to be?
Where the incremental is going to be and where the delta growth is going to come from.
Okay, sure. I think number one is climate change. I think this is an aspect that is gained the most focus. And also the other reason is because right now there are most data points that supports how we measure GHG emissions and it's classified by industries. So given the transparency of this sector, I think, and as we know, asset managers and investors do like to see a certain level of transparency before they make the investment decisions. I think this will help to drive capital towards this sector. Also, we do see a lot of interest in biodiversity and nature loss, because increasingly nature loss and biodiversity as well as climate change go hand in hand. Because just to take the example of deforestation, it actually impacts many ways. not just in terms of GHG emissions through the effect of burning, but also they're destroying natural habitats. And this is not just an issue of we're destroying wildlife and a lot of ecosystems, but it also has other ramifications because it also affects our food systems, our water security, and in terms of landscape, because they increase the risk of landslides, etc., as well as the crop yields. So by and large, we're actually gaining a lot more momentum in the other sectors, example as in biodiversity and water risk. Admittedly, not all sectors, especially when it comes to the more social aligned sectors, have that equal level of data availability. But I feel that this shouldn't deter the investment committee from actually committing themselves towards these causes as well. Because what's most important, I think, is to have this sense of credibility. It's not just because there's available data, but when you actually engage in your investment process, be very transparent in your process and to actually detail the methodology and to be transparent of where you see the areas of development.
That's great. So what I'm hearing is that there are certain areas where we would call the hotspots right now.
That's right. Yes.
Yes. Okay.
I'd also like to add that because I was quite interested in the idea of transitional financing, as what Joanne has mentioned. And I think this is an area that's very challenging because we do understand that it's inevitable that asset managers, investment firms may have to continue to invest in companies that have a very large exposure to the brown industries. And we are not saying that they should be excluded, because by excluding, we are not actually maximizing the ESG impact, which can be better managed through active engagement with them. So in this way, it's also, we feel, is a form of a transitional kind of investment, whereby through active engagements and guidance, we actually help these industries to transit towards sustainable practices. This is an area which we feel that the Asian investment community can definitely have a lot of room to grow. To take the example from what has already been done within Europe and the US, where active stewardship is something that is more established, but I feel that we in Asia are very well placed to do the same.
Thank you. And that is really a great lead into my next question. I heard Asia being mentioned quite a few times by all the panelists. And of course, we know that this is a huge, huge growth over here as all the different countries in Asia is trying to pull our weight up and really scale up on this. So my next question is going to be for David. David, from your own experience, right, for Prudential, how would you see the difference? What are the marked difference between operating in Asia versus in Europe, for example, and in terms of managing risk exposures, right? For the Bank of England, as you know, they are piloting right now the climate risk scenarios with the FIs. So in that sense, where do you think are the learnings between the regions, as well as where do you think the differences are?
Right. Thanks for that, Shereen. I think, yeah, as you correctly pointed out, we, as a group based in UK, Prudential PLC, we became a signatory to the TCFD, for example, in 2019, right? So that started, and we also managed to incorporate those TCFD disclosure locally here in Singapore for our 2020 ESG report. So I think, you know, we are definitely in a very good place when we received and saw the MAS environmental risk guidelines in terms of what we need to disclose. So that's the good news.
I can imagine.
Yeah, absolutely. So, but I think in Asia, it's a little bit different in the sense whereby I almost feel like we are catching up in Asia at different speeds to what has already evolved in Europe. And I speak it more generically, right? Of course, there are some more forward-looking jurisdiction, Singapore being one of them. Hong Kong, I think, is also very actively looking into that space. But just that different speed, I think for a company like us operating in it, we are almost compelled to take the highest standard across all, right? To make sure that we are disclosing more rather than less based on the requirements. But I would say even in our interaction with the different fund managers, right, we have discovered that I think with regards to taxonomy, disclosure standards, it can vary quite a fair bit. And even today, I think it's still developing. right? So one of our partners have even said that maybe their fund fact sheet going forward could be 20 or 30 pages, right? To make sure that it covers the whole of Asia, depending on what needs to be disclosed. That as an example. So I think that maybe is one of the key difference, I would say, between what has developed in Europe, for instance, where there's a more standardized taxonomy, Article 6, for example. I think these are the things that have come up. It has taken them a very long time to come out with it, right? Let's not kid ourselves. So I think likewise, Asia will likely go through the same phase, albeit I think in a more shortened time, right? It's almost like, let's get there in a shorter time compared to the last 20 years that our UK and European counterparts have had.
And I just wanted to also ask your views on this. In my own work that I do, right? I do find that actually it has made me appreciate the differences in culture even more now. As we talk about sustainability and how the way you do business over here in Asia, which is a very different proposition from, say, for example, in Europe or the US. And for myself, that has been a really interesting kind of reflection for me around how do we get businesses in this part of the world out of their shell and be able to kind of think about working differently or working together. But I must say the response has been really good.
Yeah, no, absolutely.
Yes, and I wanted to ask, right? So for yourself, in terms of transferring some of the headquarter officers' practices in terms of the work they are doing via CBES or, say, for example, their climate risk management policies to local, how has the experience been? Has it been different in that sense in terms of local implementation?
Yeah, okay. So Shireen, on this, maybe I will just take a few minutes to talk about,
Sure.
In terms of the climate-related disclosures, what we have focused on, and then before I talk about how that translates. So I think for us, just generically across the insurance business, we identify a few key areas in terms of how climate risk, for instance, can affect our business, right? So one obviously will be in terms of the investment assets. How will the companies that we are invested in innovate and adapt, right? On the insurance side, which is our core business in terms of underwriting, I think that becomes a little bit difficult to translate climate impact into mortality risk, for example. But because of that, I think we are also having this bit of look into how can we refine our underwriting models, right, and assumptions to be able to incorporate some of this risk. So these are, I think, just some of the examples where I think across the group, it can definitely be translated. What we try to do is we don't want to be overly prescriptive because we also recognize that different local businesses may have their regulatory requirements. They may have their challenges when it comes to the investable space. And I think the third, maybe to your point, is more on the cultural bit, right? Because we also know that, okay, here today we are talking about climate risk. Sustainability is a lot broader than just climate, right? Evelyn, I think earlier shared about some of the other things. Water, for example, there are so many things that we can look into. So I think we are trying to get that fine balance of having a central guiding principles, right, that translate into our responsible investment policy, and then let the local business unit have their own autonomy, right? Some leeway with regards to the actual implementation.
That sounds like a very sensible approach. And in implementing, I think some of these climate risk policies, right, within groups, one of my observations also has been that, of course, we know it is not just about embarking on the climate journey, but we do have to take the economics of the entire decisions into play, especially when it comes to commercials and balancing between your short-term and longer-term returns, right? And I would say that this is a very common discussion we are having right now about calibrating appetites towards sustainability. So I wanted to also ask Joanne, since StanChart also would be implementing the climate risk guidelines similar to Prudential and bringing over some of the best practices, right? I do notice that you have a tagline that says never settle. And that really caught my attention. So when we say never settle, how would this actually work out, for example, in some of your decisions or your thinking around investment, cost versus benefits?
Thank you for that question. I think this is also really relevant to us. I think as David mentioned, so we are also under the Bank of England climate stress test. So it brings together teams of like adapting to climate, helping our portfolio adapt to climate, and also the unique Asia context. And I think that ties into us trying to act out this level setter like tagline, so to speak. Because what we find so far will be that there are a lot of unique exposures in Asia. For example, Asia is still quite dependent on like high emitting like fossil fuel related industries, and a lot of the, for example, trade finance, which is also another area that we are quite big in. So I think we are one of the top 3 trade banks, and this means that a lot of the supply chain currently sits in Asia, where there is unique challenges of climate, of environmental and social balances. So as we also prepare for the climate stress testing, and then starting to get an idea of where the risk lies in our portfolio, I think this brings back also to the previous themes that have been brought up by Evelyn, by David as well, that and yourself, that we can't just exit or decide to leave certain segments of our portfolio uninvested or unbanked. And what we are doing here is to come up with transition roadmaps, which are detailed for industries. So this will be like the steel industry or the aviation industry, that we will map up within these roadmaps. What are the technologies, for example, that they can pivot towards in order to stay relevant as climate change becomes more at the forefront of investors and lenders' minds. We're also looking at how to help them establish transition frameworks. So this will be helping them understand, for example, how within an industry, by looking at maybe like IEA goals or in Science-Based Targets Initiative pathways, how can they get to that 2 degrees Celsius, and what kind of like assets they either need to acquire or increase their like asset allocation into in order to reach that pathway. And we are there to support them financially in providing finances and lending towards such pathways, and could also do bonds as well if they want to tap the capital markets. So this is one of the ways that I think we are really trying to put an effort into, and these roadmaps will be rolled out across industries in the coming months or so. So we are really like working from the sustainable finance team, I guess, working with the coverage teams, the relationship managers, to really reach out to our clients and guide them on the way on how to transition.
Gosh, I mean, to be honest, I think this is a massive, massive transformation journey for all of us here. And I would like to, since David and Joanne has shared, Evelyn, can I ask you, so is your sensing for WWF, knowing that you work with a lot of these different sectors, is the financial services sector doing enough? Do you have a wish list?
First, I would like to say that, honestly, I think the Asian financial institutions have been progressing at an amazing pace.
Yes, amazing.
Given that they started on this journey much later than their European counterparts and also American counterparts. And I can understand the pressure because because given the heightened awareness already built up, as well as the implementation of a lot more regulations coming out from the EU, for instance, as led on from the Paris Agreement, there is increasing scrutiny on the Asian players in terms of how to actually match up to the European standards, both in terms of our own framework, our own taxonomies, as well as our own best practices. So amidst all these pressures, I think that the Asian players have actually really stepped up. And yes, admittedly, for some, they are still early on the journey, but I feel that in terms of the level of commitment and the pace at which they're improving, I think it's very encouraging. And I think they will get there in a shorter time than what we had earlier expected. So we are too very encouraged that there is this real push towards financing of transitioning industries, and also it comes with more hands-on guidance into how to actually help these industries transit, and also in terms of the targets that's given to these industries. Given the and actually this is and I think following from this is also reflected in the new PRI standards, reporting standards, that what the networks would like to see is level of linkage between these investments and the ESG outcomes. So after these investments are done, all this financing has been done, what exactly is the environmental impact and ESG outcome from this? I think the level of reporting from these efforts, if it's disclosed, I think would lend a much stronger message towards the importance of sustainability. And this is something which I think the financial institutions can definitely broaden the scope on. And I can understand that for financial institutions, at the end of the day, bottom lines are very important. Because in my past life, I did come from asset management background. So I would say that most of the efforts always start and end as to delivering the capital gains and to beat the benchmark for our clients. But there's also a lot of other so-called unmeasurable efforts in terms of publicity and disclosures and the reporting outcomes, which may not directly translate to any form of capital returns, but actually goes a long way in positioning the financial institution as being relevant and competitive in this ESG space, because I think that ESG is a trend that will stay.
Sounds like we are very confident about what we are doing over in Asia, and I'm really, really, really proud of that. Okay, I am conscious that the audience has a lot of questions. I think some of them are relating to the returns on sustainability and how do we measure that. But before we go into the Q&A, can I just get everybody to share your thoughts, maybe one concluding remark around what is that message that you want to get across to the audience that we have today? And who would like to go first? David, can I invite you?
Yeah, sure. I thought ladies first, but yeah, happy to go first. I mean, we recognize today a lot of the actions being taken by companies are partly influenced by regulatory movements, right? The regulators, I think, have stepped up in terms of asking questions, setting guidelines, consultation papers, etc., all across Asia, right? In fact, globally for that matter, which I think is a good development because we understand, I think something like this, it requires a concerted effort, right? It's almost like you need a public and a private partnership to push these things through. I would say on the private side, there also needs to be more actions taken, right? Of course, we have seen, you know, the flux of ESG products out there, climate-focused strategies, which is great. But I think we're still at a very nascent stage as to how can we better define it, right? Just to give an example, I posed a question like, okay, are there any gender diversity funds we can look at, right? The answer is you probably get a handful. So I think as we broaden into this whole ESG sphere and talk about sustainability, I would like to see it also broaden wider beyond just climate, right? Because there are many issues that the world is tackling. So I would say this concerted effort becomes very important between the private and the public space. The last bit I just want to add, in case I take away my fellow panelists' talking points, is that education piece. I think that is so critical, right? Because we are still at a very nascent stage in Asia. You talk to 100 people on the streets, while we are all here very excited, I wouldn't say that, you know, more than half of them know exactly what's happening and how can they also act in order to make a positive impact. I think that becomes quite important.
Yes, agree. Right, okay. Thank you so much, David. All right, Joanne and Eveline?
Okay, maybe I'll go next. So just following up from what David mentioned about how this push on ESG integration and sustainability, it needs the cooperation from stakeholders, both from the regulatory standpoint as well as the private sector. I think I totally agree with that, because I think both sides need to hear from each other in order to make this whole thing work and to have frameworks that are robust and actually stand up to scrutiny. Having said that, I do also understand that for many industry players, they're at various levels in terms of the ESG journey, and in terms of resources, it's also varying, because I think for the larger establishments, they could be better resourced, they could lean on headquarters. However, for smaller players, they may feel that they're going to be left behind. And I think from the perspective of WWF, I think what we want to say is that it really does not quite matter where you are in terms of where you are in the journey, because I think what really matters is the spirit with which you approach this notion of sustainability, and to approach it with a genuine commitment and as well as accountability towards your practices. And resources in and data points, for instance, will be available, I think, sooner than we expect, because I think with increasing awareness, there'll be more and more such resources into facilitates ESG integration down the line. So I think for all financial institutions, as long as in your journey towards ESG integration, there's appropriate disclosures and transparency, I think that they will get there a lot sooner than what we think.
We'll keep our eyes peeled every day. All right, and Joanne, yourself?
Yeah,
thank you.
I think, yeah, thank you so much. I will also like to, I guess, echo the sentiment that we should, don't let how do I put this correctly? Maybe don't let perfect be the enemy of good in this sense, because I think we're all super early in our ESG journey, and no one can wait to get everything perfectly before you maybe decide to disclose or do something like get a rating, for example, if you're a publicly listed company. So it's about, I think, disclosure and transparency, which I see in terms of in Asia as a whole. This is generally a bit lacking behind Western counterparts, but it's something that it's a really important first step. So you don't need to get all the whole list of disclosure, like greenhouse gas, water efficiency, I guess social impact. Just one or a few will be enough to actually start conversations and opening doors to investors that are conscious about ESG and rather keep your voice and keep visibility there in the market. And I think that's something really important.
That's very assuring and also I think practical. So any step that we take, I guess, would be better than no step at all.
Yes, indeed.
Okay, that's great. Thank you so much, everybody, for sharing. And I think it has been a lot. Okay, so let me see. We do have a question around how is it possible to include ESG matrix into valuation and required return on capital. I think we touched on this a little bit more just now, but perhaps if we could have a little bit more concrete examples for the audience on an anonymous basis, that would be very helpful. Or maybe what are some of the challenges and the learning points?
What kind of just go first and provide some ideas around how maybe we are understanding it. So in terms of us, it will probably be looking at how this impacts something, a matrix like the EBITDA or the returns in terms of our portfolio. So in terms of maybe I'll use climate as a scenario as an example. So I think this requires actually a lot of capability and technical ability to understand, for example, stress testing parameters, which will include factoring in, I guess, a weightage for early or late policy action. And I guess if this comes in later, for example, there will be a harsher impact or discounting on the profit or margin of companies that are not adapting. So there will be a time factor. There's a policy action consideration and drivers like energy demand pathways, which we are seeing increasing popularity of renewable and clean energy. So if a company is exposed to a lot of heavy emitting, this could be stranded assets after a while, and a certain discount will have to be applied. Carbon pricing is also another area where I was mentioning earlier, this could be another revenue stream. So I think there are these aspects to break down when it comes to understanding a portfolio. So it's not that simple, but in terms of doing so, I think it's not undoable either. So it's something that I think requires us to sit down, brainstorm, think, and this will see how it affects our bottom line.
David, in your organization, for example, would you also be similar to Joanne, kind of thinking about the matrix, the approach, as well as I think I am also quite keen to understand around the time frames, right, for returns. Has there been any shift, I think, in the behaviors or expectations around when this return is going to crystallize?
Yeah, actually, it is a very good question. I don't know whether I have a good answer in response to that, because just looking at it from a numbers perspective, I think if we are able to quantify it so clearly today, it is almost like a no-brainer, right? Positive MPV, let's go for it. But I think the challenge that we have here today is we don't have that hard science today, right? That is reliable for us to then say, yep, let's base on these numbers and go along with it. It doesn't help that there's no common reporting standards across companies. So I think what we are therefore doing at this stage is really a point that was raised by my fellow panelists earlier, in terms of the capacity building, I think that's going to be quite important because today we are, I think, road testing several of the usual main providers in terms of how do we analyze the financial impact, etc. But I think going forward, the capacity building and the capability to then say, build our own model to be able to price in the assumptions on how that will affect our return on capital, that will be something that will need to occur. And I think maybe the shortage that we have today, I saw there was a question, somebody would like to start a career in sustainable finance. 100% recommend you because there is a great shortage, which is why, like what Evelyn said, all this IBF accreditation, those is a sign. Those are things that shows that there is a shortage of this type of expertise today, which the companies will be looking for in the years ahead.
Yes, I would agree around the shortage of expertise. Definitely something that we need to build. Is there going to be a chance where we are concerned, for example, with getting it wrong? I know perfect is not supposed to get into the way, but what happens if we, I think, and this is some of the fears that we see, right? What happens if we do a stress test scenario, for example, and we get it wrong?
Yeah, absolutely. So I think in terms of the stress testing bit, which again will come up to be very important for companies here in Singapore. I think the importance is to be able to look at, just like anything risk related, not to look at it on a single metric, but look at it from a multiple dimensional basis, right? I think climate has done the most development. There's weighted the WACI, right, which is the carbon emission intensity. There's also, I think, climate VAR. You know, these are different metrics that has been developed. I would see it will just be part of the overall risk integration as companies look at climate risk from different dimensions.
That is good advice. And can I ask, maybe I want to just open up to the audience here as well. I do think that I would agree with David when he says that a career in sustainable financing is definitely a plus. I would say, okay, hold on, sorry. Just give me a second. Also, I think we have some other questions here if you'd like to talk about this. We have a question maybe for Evelyn, can answer this. Engaging the brown fossil fuel institutes or industries require transparent and high environmental standards to ensure that there is no greenwashing. So who are the key actors in Asia to oversee and enforce these standards? And this is a question from Christopher.
That is a very interesting question. Yes, the reality is that I think was mentioned by Joanne as well, that a large bulk of all these heavy industries are found in Asia, and this also includes fossil fuels. So yes, there would need to be a very high degree of transparency to monitor and to measure the ESG impacts from these industries. The logical answer would be that the regulator should be monitoring. Having said that, I do understand that for various markets, I think the regulators are also at various stages of implementing on these regulations. So in the given the differences in regulations across Asia, we actually left with pretty much the private sector to effectively do this kind of vigilance. And do not underestimate also investors, because today's investors are a lot more informed, and they do actually they demand certain level of disclosures, especially for corporate investors and pension funds, whenever they see that the investment involves these fossil fuels, and if they do have any ESG criteria. Also, having said that, given, as I mentioned earlier, greater international scrutiny coming from international networks like the UN, PRI, we actually do see certain asset managers internationally getting called out, let's say, for greenwashing. So I think this does send a message, even though it's not from a regulatory standpoint sometimes, although sometimes, yes, it's from a regulatory standpoint, but in any case, given the publicity around financial institutions sometimes getting called out for stating something within investment policy and then doing something else, I think this also lends certain level of caution on the part of financial institutions to actually be more accountable in terms of their responsible investment practices. As I mentioned, I think investors are actually quite reasonable in the sense that they're not expecting perfection. They're not expecting the gold standards as of today. But at the end of the day, I think the level of transparency and accountability and credibility in how financial institutions are actually disclosing their practices.
And do you think that, since we're on this topic, do you think that the newer requirements thinking about assurance over some of these ESG disclosures will be helpful to the whole conversation?
Lower requirements in terms of ESG disclosure, is that what you said?
As in newer requirements around requiring assurance or independent assurance over these indicators.
Yes, so I'm glad you brought up this point, because this is also another aspect that we at WWF have actually been engaging with financial institutions to get them to obtain maybe third-party assurance. I mean, that is our wish list. If not, at least we have all their practices and policies internally audited, and to have a statement to be disclosed that they actually carry out this practice. In terms of best practices, of course, we would like to see them disclosing even the results of the audits. But like I said, it's just at the wish list level.
Agree. And I'd just like to share from an audit firm's perspective, since KPMG is an audit firm, we do get a lot of these queries, and where we are seeing is very interesting, because in order to effectively audit ESG disclosures, of course, IFRS has also stepped into the picture. I think the question for us is, how do we integrate a kind of knowledge, the audit methodology, the audit skill set with sufficient subject matter expertise in the varied topics that we have mentioned. And so in all sustainability assurance, I think we are quite careful around the kind of teaming that we are doing, so that, we are actually effectively addressing the risk of an engagement in terms of greenwashing.
Yes.
We still have a few minutes, so I'm just going to take the question from our participant in Thailand, where she said that she was very interested when we talk about the carbon market, and wanted to understand a little bit more of how it will work and whether or not it will support perhaps sustainability projects outside of Singapore.
Maybe I could take that question because of the connection to the CIX. So in terms of supporting projects outside of Singapore, yes, that's the idea, that this carbon exchange will enable the financing of nature-based solutions actually pretty much in Asia as well. So since it's based in Singapore, and more than 50% actually of the world's natural offset supply lies in Asia. So CIX is actually really open for project developers to start contacting it actually right at the moment. So we're actually having a few conversations as well about how we can help be that conduit to channel capital to their projects, and they can supply us with that pipeline of high quality projects. So that means they will also need to, I guess, both of us have to meet each other halfway. So they will need to be agreeable to certain ESG standards. And I think Evelyn and Shireen were talking about verification standards and certification as well. And that's something that we'll have to do. And when they are agreeable with the whole sustainability thinking and trajectory behind CIX, and then that's where this could be an additional capital revenue stream for them.
So am I right to say that CIX is actually open for business, essentially?
Yep, we are definitely open for business now, and heading towards actually launch at the end of the year.
Yes, that's very exciting. David, just one last question, since we have you here with us. It is really around that topic that we are discussing around the cultural differences in Asia, right? And we have a question here from our participants in India that says that, really and very observant, that Asia is really not a homogeneous entity, though we tend to just refer to it as Asia. And really, where would be some social nuances that you would see that needs to be managed, for example, as you navigate the sustainability waters over here in this part of the world? Would you be able to share a couple of examples?
Yeah, I think on this, it's a good point. Asia is not homogeneous, right? Whereas I think a continent like Europe you probably have it a little bit closer in terms of development. So I think in terms of our footprint in Asia, we have the very developed markets and very developed financial institutions, Hong Kong, Singapore. I think they have been a trendsetter in terms of disclosure requirements and ESG standards. Then you have the other extreme whereby there are still some countries which are barely opening up and very reliant on the traditional sources of fuel, right? Since we're talking more about climate and fossil fuels today. I think what our approach is not to come in and say, you have to do this, right? You cannot have any coal companies, investor, no businesses with any of these companies. I think this is not the approach, right? One thing that we do is more on the engagement bit, but importantly, I think maybe as a group, we also recognize the differences, and it's important to emphasize that the targets that we have set is therefore at a group level, right? We may start to see that some of the business units may need to do a little bit more in order to compensate for the others, which for business reasons, cultural reasons, or just for very practical reasons, they cannot exclude or avoid any of these investments, right? So that is the kind of approach that we are taking. Earlier, I think at the beginning, I talked about more of an inclusive transition. That is, I think, something that I just want to emphasize also. Right? We have to make sure that our businesses across the region are able to progress in this journey with us rather than to leave behind the rest because, yeah, they can't do it, let's leave them out of the picture. So it is the inclusive approach that we are undertaking.
I think that's a great point, right? And I think just to weigh in on that, it will really be actually at the subliminal messaging, although we are always talking about environmental and climate, for example, in this forum, there is also a lot of social implications around inclusion, as well as respect for people who are different from us. So, for example, in our team, we always say, right, diversity is easy, right? You can assemble a bunch of people who are different, but inclusivity is a different matter that takes work. So thank you so much. I think we have come to the end of our session. That is 5:02. And David, Eveline, and Joanne, it was lovely chatting with you. And I'm going to hand back to Prachi right now. Thank you to the audience as well.
Thank you, David, Eveline, Joanne, for such an interesting discussion today, and for Shireen to navigate through this beautiful, panel and discussion this afternoon. Apologies if you were not able to go through all the questions, but we will surely share these questions with the panelists. And thank you for being such a wonderful audience and for supporting us every month for these sustainability dialogues. And we look forward to seeing you next time. Thank you.
Thank you, everyone.
Thank you. Bye-bye.
Bye-bye.
Thank you.